Thanks for joining me here at NTD Business. A few things to talk about today. American multinational tobacco company Philip Morris International has a higher ESG score than Tesla. This is according to S&P Global. Philip Morris International is the maker of Marlboro cigarettes. It scored 84 out of 100 on the ESG scale. Tesla scored, on the other hand, 37. ESG stands for Environmental, Social, and Governance. ESG ratings are supposed to guide investors and their money toward ethical enterprises. Now, keep in mind that Tesla makes environmentally friendly electric cars. It's the largest electric vehicle manufacturer in the world. Meanwhile, according to the World Health Organization, the tobacco epidemic is one of the biggest public health threats the world has ever faced, killing more than 8 million people a year. One Twitter user asks, how could cigarettes, which kill over 8 million a year, be deemed a more ethical investment than electric cars? The Washington Free Beacon reported on this earlier this week. It argues that tobacco companies are gaming the system. Some tobacco companies have gone out of their way to emphasize the diversity of their corporate boards and the breadth of their social justice initiatives, from funding minority businesses to promoting transgender women in sports. But Tesla, whose executives are overwhelmingly white men, has resisted that bandwagon, going so far as to fire its top LGBT diversity officer last year. The Beacon also says that Philip Morris International, in its 2022 ESG report, bragged about empowering female tobacco farmers. Women involved in tobacco farming often face structural and cultural barriers. But despite Philip Morris International having a higher ESG score than Tesla, it seems overall companies are toning down their promotion of ESG, actually, according to data from financial research platform AlphaSense. Executives at U.S.-listed companies mentioning environmental, social, and governance, diversity, equity, and inclusion, or DEI, or sustainability on earnings calls from April 1st to June 5th are down 31% from the same period last year. And the European Central Bank raised interest rates to their highest level in 22 years on Thursday. Officials also left the door open to more hikes. The ECB increased its key interest rate for the 8th consecutive time. It's sitting at a 22-year high of 3.5%. The central bank for the 20 countries that share the euro also said it expected inflation to stay above its 2% target through 2025 and hinted once again at more rate hikes in the coming months. The ECB's latest hike followed the first pause in the U.S. rate hikes in over a year, which could be a signal to investors around the world that the current tightening cycle across developed economies is nearing an end, even if a little more U.S. tightening is still possible. Eurozone inflation has been moderating for months, courtesy of lower energy prices at the steepest increase in rates in the ECB's 25-year history, but remains unacceptably high for the ECB at 6.1%, with underlying price growth only starting to slow. So we had the Federal Reserve's interest rate decision yesterday, but how is it impacting regular Americans? And what can you do to protect your money? We have here principal U.S. economy reporter Sarah Foster at Bankrate.com. So we had the Fed decision yesterday, and on the website, Bankrate.com, you wrote an article about 11 financial things to do after the decision yesterday. We didn't get a hike, but I want some context to that article. Maybe provide us with some backdrop. What's the economy like? What's happening to the consumer?
Yeah, well, it's a monumentous occasion here at the Fed because they've been hiking rates for 15 months, 10th consecutive rate hikes. They broke that streak yesterday in June, deciding to leave rates in the target range of 5 to 5.25. And so I think, the context, what this means for consumers is that they might maybe be breathing a sigh of relief, but the celebration won't last for long. I think, obviously, the economy has continued to surprise Fed Chair Jay Powell and even economists out there as well about how resilient it's been. And in light of the resiliency, the Fed is likely going to raise interest rates 2 more times, at least according to the median forecast.
So what's the impact on the consumer with this Fed funds rate being at around 5%?
Well, that's the highest in nearly 16 years. And so, what that's translating to for the consumer is higher borrowing costs. For 13 weeks, we've really seen credit card rates stay at this record high level. We've also really saw that home equity lines of credit, they're the highest in decades, as well as car loans. Consumers have been dealing with high inflation. Their wages haven't been keeping up with it. But on top of that, we have this new era of inflation, which is brought on by these elevated borrowing costs. And even though the Fed decided not to raise interest rates, those borrowing costs are still going to stay at those levels. And they could even nudge up a little bit higher as we kind of process what happened with the three bank failures earlier this year.
And just to put things into perspective, maybe you can give us some examples of the impact on people's wallets. I know you mentioned credit cards just now.
Yeah, I think it's really important here for consumers when you kind of look at these borrowing rates, how much they've risen. Since credit card rates are kind of rising to this record high now for so long, what that means for consumers is the balances that they keep on those credit card rates, that's going to cost them hundreds of thousands of dollars, potentially, depending on how much of a credit card balance they carry with them. So I think, the bottom line for consumers is the most important step you can take right now is really making sure that you eliminate that credit card debt and even other high interest variable rate loans. Anytime the Fed raises rates, you're kind of a sitting duck for paying from those rate hikes. And thankfully, since the Fed didn't raise interest rates, this week, you might have a little bit of time to figure out what to do. But again, the picture doesn't change that much. And so what we really want to show is that it's important to find ways to eliminate those forms of debt.
So big picture wise, I know you just went to some detail about the article, but what does it help people with, broad strokes? The article.
So I think, as far as the article, what we really want to show is what the steps that Americans can take with their finances in light of the Fed's decisions, because the Fed really is one of the main ways in Washington that policymakers have a direct line to your wallet. So kind of broad strokes here, we just want Americans to kind of take stock of their finances, look how much debt they're carrying, see ways to eliminate those balances, and even find ways that maybe you're keeping cash on the sidelines, not letting it work for you. I think we've obviously talked about the pain of higher rates, but there's also a bonus here. We've seen that savings yields have hit the highest since 2008, but if you bank with an online bank, they're even higher. That could translate to a yield that's about 400 to 500 times higher if you're banking with Chase or Bank of America. So it's really important to just not only find ways to make sure that higher rates aren't hurting you, but also find ways that higher rates can help you too.
So out of the 11 things, I know you mentioned some of them already, but which one do you think it's the most important?
I think going forward, the most important step Americans can take is just making sure that higher rates aren't hurting their wallets, because when inflation is already costing you lots more money than it would have before the pandemic, higher interest rates also now are too. So it's just really important to make sure that when you look at those credit card balances, if you're carrying any, find a way to take advantage of a 0% transfer offer with a balance transfer card. And of course, the elephant in the room is that the Fed could cause a recession by all of these interest rate hikes. Another kind of interesting point from the meeting yesterday is that the Fed is expecting the economy to remain resilient. And many Fed officials, including Chair Powell himself, has talked about the hope for a soft landing. But of course, if we do enter a recession, as many economists have been forecasting, balance transfer offers could dry up. So essentially what that means is that it's important to take advantage of this now to make sure that you don't miss out on the opportunity later.
And I think that's one of the points in the article. How do you recession-proof your finances?
Recession-proofing your finances really comes down to looking at the money you have coming in as well as how much money you have coming out. So I think the best step you can take is just looking at your budget and making sure that you're cutting costs enough that you can put money back into an emergency fund. The emergency fund that you have is the way that you can hopefully help sleep well at night in the fear of some of these tougher economic times. But even more broadly, recession-proofing your finances can come down to looking at your careers too. It's an important step. I think I just wrote an article about this as well, about how Americans are hoping that a recession won't interrupt their careers. obviously your career is something that can maintain your job security, can help keep you afloat even during a recession. But if you face job loss, it's important to start looking at your network as well, and maybe also finding ways that you can boost your skills. I think all of those kind of come back to helping you weather a recession.
So I'm looking at the article here. The number two thing you said was to find out what's good and bad debt. Maybe you can talk a little bit on that.
Sure. So the way we think about rate hikes and how they impact consumers is if you're holding on to variable rate debt, you're going to be hit first. But if you have a fixed rate mortgage, for instance, that you locked in back in 2021 when rates were at those record lows, you're safe from higher interest rates. And so what I think it comes down to is thinking about what is hurting you and what isn't hurting you. And of course, because of the way inflation works, if you're holding on to a fixed rate debt, paying money back to it, actually that's kind of a better deal because you're paying back with devalued dollars. So essentially, paying off your mortgage or something like that that's a fixed rate debt might not be the most important step you can take with your finances, because the money that you're spending putting towards that balance could be put elsewhere to hopefully help you either make more money down the line or eliminate the cost of higher interest rate debt.
And of course, we're talking about debt, and that can't be separated from good credit score, and that was one of the points as well. So why is it important to boost your credit score in this context?
Yeah, I think obviously the Federal Reserve plays the most important role in interest rates across the economy because they set the benchmark rate that influences all other interest rates. But even so, lenders have a lot of discretion on what they charge consumers who are going to a bank to maybe take out a loan, and especially with credit card issuers themselves. And so I think what is most important is if you have a credit card or if you're thinking about taking out a loan, making sure that you maintain a strong credit profile, which includes making all your payments on time, keeping a low debt utilization ratio. All of that can help you because at the end of the day, your credit score will impact the individual rate that you receive. And if you're a so-called safe borrower, at least in the eyes of a credit card issuer, you're hopefully going to be able to receive an even better deal than some other people throughout the economy in this rising rate environment.
Is it very difficult, in your opinion, to save during this inflationary period?
Well, actually, I think we have some good news here for savers because what we found out this week is that inflation, at least overall, has fallen to about a rate of 4%. That was after soaring to a high of 9.1% just last summer. And so what I think that means now is a lot of accounts on the market, especially high yield savings accounts, are offering rates that are close to 5%, if not higher. That now means that the cash that you're keeping sitting on the sidelines isn't losing as much purchasing power as it was before. So this kind of makes, even though the Fed could be slowing its pace of rate hikes, obviously we're closer to the end than the beginning. So that therefore suggests that savings yields are close to the peak. But that doesn't matter here, essentially, because there's this new win since inflation has cooled. But even more broadly, I think obviously saving is an important step for your finances because it helps you prevent having to accrue unexpected expenses on your credit card. And so you think about that kind of as the line between 20% credit card interest rates. And so at the end of the day, what I think that suggests is that savings should be a priority no matter what inflation environment we're facing.
Or maybe just one more question. What's the bottom line?
The bottom line here is that interest rates are at a 16-year high, at least from the Fed's benchmark standpoint, and they're likely to rise even higher. So it's important for consumers to take advantage of this time while they can, look at their finances, find ways to make sure higher interest rates aren't hurting you as much as they probably could be, and make sure that you're taking steps with your wallet to hopefully help safeguard you in the face of a recession.
All right, thank you so much today, Sarah. It was a pleasure speaking to you.
Great to be here.